It's easy to invest in Uber when it's Uber, but it's harder to invest in Uber when it was an idea on a deck about, making taxis callable from your phone. And that sounds crazy, but the people that had the vision and could see how that could become a multi-billion dollar opportunity were the people who became insanely wealthy through that company. And so I think it's a lot the same with real estate. The pioneers who have the vision and who are able to sniff out the next new thing are the ones that often make really big returns.
I'm here today with Janine Yorio. She was the CEO of Compound, which is reimagining how the world invests in real estate, empowering investors from diverse backgrounds and geographies to own a piece of the cities they love. Compound was acquired by Republic in June of 2020, and Janine is now the co-head of real estate at Republic. Janine, welcome to The Confident Investor.
Thanks. It's great to be here.
I'd love for you to tell us about how you first got started in investing in real estate, what drew you to it, and how did you find your passion in that?
So I grew up in a family of architects. My grandfather was an architect, my mother is an architect, and her twin sister is an architect. And so I was always surrounded by people who had rolls of tracing paper and were drawing buildings and visiting construction sites. And my mother was actually a single mother, so oftentimes she would drag me along with her on business trips and to business meetings. And so I was always inside buildings from a young age, measuring them, talking to the owners, kind of being part of that whole construction process. So I think it's just really been a part of who I am, like wanting to be part of the built environment, wanting to be on the ownership side and understanding the process of building a building and how long it takes to build a building, but then once you do, it can live on forever. And I always found that kind of exciting and reassuring at the same time. So when I graduated from college, I started working in real estate soon after, and I've been doing it for my entire career.
Awesome. So for those of us who are unfamiliar with even just the basics of real estate, commercial versus residential, like where do you start and where did you really first gravitate towards?
So, my career was a bit different because I started professionally. I wasn't investing avocationally. I worked for a big private equity firm, and so I was investing on behalf of pension funds and endowments. But then in my personal life, I started buying apartments in New York City, which is where I live, and buying them and renovating them and selling them. And it has been a very long period of prosperity for New York City real estate. So that was a pretty good side hustle to have. So at work, I was buying office buildings and shopping malls and large resorts and hotels. And then after hours, I was buying apartments and gutting the kitchens and bathrooms and flipping them. So it's kind of consumed my entire existence. Still to this day, I'm doing that very same thing, both commercial during the day and then buying and renovating homes and at night and on weekends. So I love it. But I think for the early investor, for somebody who's just getting their feet wet, it's always important in investing, no matter what the category, to start with what you know. And the reason why so many people, their first real estate investments are residential is because everybody has someplace to live. And so it's something we fundamentally understand. Before we're ever able to make a spreadsheet and really quantitatively analyze a real estate transaction, we all, when you go try to find a place to live, you have to figure out, does it have all the things I need? Does it have a washer, dryer? What's the rent? Can I afford it? It's that same calculus you do when you think about investing in residential real estate. And so it's a very easy gateway to investing. So I would encourage people to start looking at things that are within your reach in places your hometown, the place you live today. And then as you develop more sophistication and comfort with the asset class, then you can branch out. There's no reason why you couldn't think about buying a residence that has a store below or an office building that's a live workspace. So you can sort of migrate out if you're looking to make direct investments. And then obviously through platforms like ours, you can make even smaller investments and invest across lots of different categories so that over time you can develop more proficiency about different types of real estate investments.
How should people think about real estate as an asset class within their portfolio? Like what percentage would you say is a good place to start?
So, look, most Americans tend to be very heavily weighted in real estate, especially as they get older, because they buy a home and it tends to be kind of their primary store of wealth. The traditional asset allocation model is for about 5 to 10% of your wealth to be in real estate, but the less wealthy you are, the more that percentage tends to be skewed. You should think about real estate. It's hard today because with all of the excitement over investing in the stock market, people are expecting moonshot returns. Bitcoin goes to the moon, stocks go to the moon. Investing in real estate is a bit like watching golf or watching paint dry. The best real estate investments, like almost nothing happens. The tenant never moves out, you get your rent every month. And the investing in real estate is a lot more like the formation of sedimentary rock. Like if you don't watch it, it won't. If you watch it, it's not happening. But then when you come back 10 years later, it's happened. Neighborhoods change, prices inflate, capital appreciation occurs. So it's the kind of investment you have to be really patient with. And you can't try to take its temperature every single day and check and see how the value has changed. You have to kind of set it and forget it and check it maybe every year, make sure that the investment is still performing, but have a very long-term time horizon, like 5 to 10 years.
Hmm. So it's really, I think, that cultivating that patience that is increasingly rare, I think, when it comes to investing.
Well, it's always been rare. I mean, get rich quick that's the oldest trick in the book, right? Everybody's been trying to get rich quick. It's right after the fountain of youth in terms of things that people have been trying to figure out. So the seduction of really quick wealth schemes is always going to be kind of a red herring, and you have to outsmart yourself. If you look at really sophisticated investors, look at the wealthy people they take their gains they make in other shorter term strategies, and they usually plow them into real estate because real estate is that slow, steady, fairly conservative allocation strategy where you can park some wealth and not have to worry about it over the long term too much. It's hard to go horribly, catastrophically wrong in real estate. I mean, that's not to say it never happens, but it's the kind of asset class where you can expect sort of a fairly consistent recurrent return over time.
And what return do you think someone can expect on average?
It completely depends on the kind of investment. So the riskier the investment, the higher the return you can expect, but you should also be prepared to accept more risk. So a riskier investment means you could lose your entire investment. So the riskiest investments are things that are highly speculative, like a ground up development project where there's literally nothing there. It's just a pile of dirt and somebody shows you an artist rendering and they're like, it's going to be amazing. Invest now. We're going to give you 15% or 30% on your money. But you have to sit back and hope that that developer doesn't get too many things wrong, that the development goes off without a hitch, the site doesn't flood, there are no earthquakes or hurricanes while it's being built. Like, major surprises happen all the time during the construction process. And so construction confers a lot of risks. There are other speculative deals where you can buy real estate in very speculative locations. Like you might think that this new neighborhood of is going to be the next big thing. Your friend's opening a restaurant there. You think that neighborhood is going to be where it's at, but right now it's kind of down and out. So you go and buy a building there and you sit on it and you wait. You could be right. You could make a fortune. You could be wrong. And it becomes the sleeper that never happens. And so real estate returns really vary tremendously. If you want a really low risk investment, you look for something that's already built, that's either easy to rent or already rented out. The traditional kind of lowest risk real estate investments that institutional investors look for are what are called triple net leases. So something you might be familiar with are all the drugstores you see like in front of grocery stores. There's usually like a CVS or a Walgreens on the out parcel in front of it. Those usually have very long-term leases, like 10, 20, sometimes even 25 years. Those are called triple net leases, and those are considered one of the most secure asset classes you can invest in. So assets where you have one tenant, the tenant pays all of the expenses, and they enter into a very long-term lease. And that's an asset class that's harder for a smaller investor to get into. It's something that slightly more sophisticated investors tend to flock after. But when you think about the the risk curve and your tolerance for risk, the highest risk investments are the ones where there's lots of development or there's lots of uncertainty. And the lowest risk ones are the building's already there, the tenant's already there. You don't have to worry about very much at all.
Cool. That's a good way to think about it. What areas do you invest in and why? Or how are you thinking about your portfolio?
So, let's talk about how we think about our portfolio professionally, because my personal portfolio is a bit different. But at Republic, we're focused on major cities. We think that cities are where most growth is occurring, which is interesting because right now we're in the middle of a pandemic and a lot of people are fleeing cities. And so it's a very interesting contrarian time to have that thesis because individuals are panic buying homes outside of cities in order to get out of where they perceive there to be more risk of the virus. But we believe long term that cities are going to experience outsized growth. And we think that younger people really appreciate the urban lifestyle and that cities are finite. You take a city like Manhattan, which is on an island, San Francisco is a peninsula, even Austin, Texas is bounded by water. And there are limits to how far people are willing to commute into a city. So cities are finite. They're fun places to live. Companies want to be based there because young people, smart people, talented people live there. So there's a lot of excitement around cities. And so we look for those kinds of places. And then the specific type of real estate we look for within those cities is varied. We look at apartments. We look at single family homes, which oftentimes in cities are condominiums because they're vertical. We look at office buildings. We'll even look at retail, which right now retail is having a really tough time between the pandemic and Amazon. It's kind of been a 1-2 punch and retail is on its knees. But I believe long-term in the power of human ingenuity and that people will figure out very clever ways to fill retail spaces with new things and experiences. And so we're looking across all different asset classes, but with a really intense focus on cities that are growing.
Great. And I'm curious about personally, at what point did you start gaining confidence in your own investing capabilities?
I think even the most sophisticated investor still gets nervous the day you pull the trigger. And I wouldn't consider myself to be the most sophisticated. I've worked for some really talented people, some of whom are self-made billionaires with a B. Investing is scary, right? If it were easy and a sure thing, everybody would be rich. It always requires you to take some risk, and you kind of have to decide, are you in, are you out, and are you willing to stomach the risk? Do you have the stomach for it? I think the more you do your homework, the more research you do, I think you develop more confidence. But sometimes deals where people they go on their gut, they kind of work out okay too. There's really no one formula that works for everybody, but real estate is an intensely local business. If you think about the places you know really well, I don't know where you live, but different corners in a city or different corners in a town have a different feel. So you can be one block over and the value and the rentability of that real estate is dramatically different. So it's really hard to invest in places that you don't understand and you don't have that internal mental map about what's good, what's bad, what's tough to rent, where there's too much traffic, where there's too much noise. And I think the best investors do try to stick to their knitting and they develop a real proficiency for one area or one asset class and they go really narrow and deep in that direction.
Hmm. I'm curious about your thoughts on the trend of getting property in order to Airbnb it out.
Okay, so prior to the pandemic, it was a pretty good strategy, especially in markets that have a tight hotel market. Since the pandemic has occurred, travel has fallen off a cliff. And so right now it's risky. But as I said, when we started speaking, real estate is something that you should have a long-term time horizon for. If you're worried about what's going to happen in the next 2 to 3 months, you're thinking about real estate investing in the wrong way. You need to think about real estate over 5 to 10 year increments. In 5 to 10 years, people are going to be traveling again. Hotels will be full again. The same places that were popular before will be popular again. There may also be new places that become popular. And I think it's an interesting strategy, but it can also give people delusions of grandeur. Like you think that it's going to be so easy to make tons of money Airbnb a place, but it's a bit like running a hotel. And if you talk to anybody who comes from the hotel business, which is actually the business I come from, it's an intensely operational business where people are coming and going every day. They expect a pristine experience. The sheets have to be clean. Everything has to be clean. And the second it isn't, they want a refund. They want their money back. They want to slam you on Yelp. They want to give you a terrible review on Airbnb. So it's a tough business. And people often underestimate how much of a lift it is to deal with those nightly tenants. The reason you can rent it for more money is because it's a lot more work to deliver that experience. The cost of the furnishings is expensive. The cost of cleaning is expensive. The upkeep, the marketing, all those things cost time and money. And so I think it's an interesting model for people, but they need to be very careful about really figuring out whether they have the time and resources to deliver the experience that people expect when they come to an Airbnb. People are very discerning, and they want certain things, and they don't want to walk into anything that's filthy or unappealing, and that's hard to deliver.
Absolutely. So far, I think one of the biggest takeaways is really around investing in what you know. Do you have any other advice for investors who are considering entering the space? Perhaps if they wanted to try out something new.
Hmm. Well, I think I have a lot of cautionary advice. I think that there are a lot of real estate investments out there where you'll be shown pretty pictures, artist renderings, and this targeted IRR, this targeted return. And it's always a great number. It's like you're going to be rich. You're going to get so rich investing in this deal. And the thing people need to understand is those numbers are based on projections, and projections are very often wrong. I mean, there's not a statistician in the world who would have predicted the pandemic and what happened to the economy. And as much as this is a black swan event, unexpected things happen all the time, and not just big global things, but little micro things that also impact investor returns. And so you need to be kind of have both eyes open when you invest and understand that those big return numbers also come with a big risk. The reason why they're targeting that big return is because they had to be incentivized to take the kind of risk in order to undertake that project. And although something with like a 10% return, a 10% targeted IRR may feel less appealing, it's probably a more conservative investment strategy. Again, you need to double check everything to the best of your abilities, but you don't want to be seduced by those really big numbers and assume that that's what's going to happen. That's a possible outcome. The other possible outcome is a lot worse. It could also be better. It's unlikely, because you have to bear in mind when investors are soliciting investments, they are selling. So they're incentivized to show you one of the better possible outcomes. But you just need to be skeptical. You need to have a healthy dose of skepticism and understand that those big returns often come with big risks. And that means that you could underperform that expectation.
Could you tell us about some of the successful investments that you've had, and what was your thought process behind putting your money behind them?
So I can talk about both personal and professional investments. I think one of the more exciting ones that I remember professionally, because it's something that's easy to understand. When you work in institutional investments, a lot of the investment you do in real estate, even in real estate, is kind of esoteric. You buy mortgages and you sell off a junior piece. It's a lot of math. It's ultimately still real estate, but it's still much more structured and it's more mathematical. But I worked on a deal probably 15 years ago, maybe longer. It was in the meatpacking district in Manhattan at a time when the meatpacking district still had meat hanging from the storefronts. And there was a restaurant on the corner on 9th Avenue and 14th Street that was they had a lease there, and Apple was moving into that space. And we invested in that building. And that was kind of the beginning of the Apple Store phenom. That was before there were Apple stores everywhere. And it was a really exciting transaction because in hindsight, it was one of the first Apple deals. And now Apple stores trade like football teams. People buy Apple stores for crazy multiples that don't bear any relationship to the real estate around them, because Apple is considered to be such an amazing tenant. Oftentimes, too, an Apple store changes a neighborhood. An Apple store in a mall can revive a mall. It brings tons of traffic. And so owning an Apple store is much more than just a garden variety piece of real estate. So I think whenever you have the opportunity to touch what we call trophy assets in the real estate business, it's always exciting. I've worked on many deals like that, but that was one that's very tangible. It's on a street level. People that are familiar with New York City may be familiar with that space. It was a restaurant, and now it's an Apple store, and the owners and the investors in that project made a lot of money. Personally, I'm a big believer in buying residential real estate that just needs a lipstick renovation. I think humans are notoriously bad at seeing beyond dirt and bad design, bad decor. And oftentimes, if you can just clear out a place and paint things white and clean it, you can generate a lot of near-term profit in buying something right. I bought an apartment in New York City. It was probably 2004, and It had a horrible kitchen. It was like from the 1970s, and the bathroom had a mirror on the ceiling and the walls. So when you got out of the shower, you saw yourself in angles that you never ever wanted to see. And just taking out the mirror and putting in a new kitchen. And I didn't do an expensive kitchen. I bought and sold that apartment in under a year. At the time, I think I paid $350,000, and I sold the apartment for $600,000. And I didn't spend much more than $50,000 on the renovation. And I was pretty young when I was doing that. I was right out of college when I started doing those investments. So I like that. That to me is more of a hobby than an investment, but it also turns out to be a good business. I enjoy the design process. I enjoy the before and after, the Cinderella story. So I think that can be a lot of fun, but it's a ton of time. It's not something that you can do a lot of if you also have a job that requires a lot of focus. It's very distracting. Dealing with contractors is a time consuming mess. And so I think the fix and flip strategy, because TV shows have made it so popular, lead people to believe that it's very doable. And it is if it's your full-time job. It's hard to pull off on the side because it is so labor intensive and time consuming. But it's fun.
Amazing.
Yeah.
That's really good advice. I think that for people who haven't really touched real estate, to your point, it is hard to look past that initial kind of
Grind.
Exactly. And so thinking about it as, all you need is perhaps just, some white paint and like a little bit of, I liked what you call it, lipstick renovation. Is that what you called it?
Mm-hmm.
Yeah.
It comes from putting lipstick on a pig.
Oh, yeah, I like.
But that mentality exists in more sophisticated real estate investments too. So it's a very popular strategy to buy an older apartment community that has old kitchens. Kitchens are where you can unlock a lot of value in residential real estate because women oftentimes drive the decision to rent, and women do not want a disgusting kitchen. So a buyer, an investor, will go in and buy an old apartment community and renovate all the kitchens and raise the rents as a result and generate strong returns for their investors. People do it all the time. You see office buildings where it'll be an ugly office building and the owner will reskin the building, meaning they put a new facade on it. Again, lipstick. They're just putting lipstick. The building is still in the same spot, has the same ceiling heights, but it looks better. And in doing so, you can raise rents and unlock value.
Great. And on the flip side, can you tell me about some of the mistakes that you've made from some investments that didn't yield the returns that you wanted?
I think people think of real estate as a way to generate passive income. And I think if there's one theme about our conversation today, it's that investing is still a lot of work. Whether you're doing fix and flips, you're operating it as an Airbnb, or you're doing more sophisticated institutional style investing where you have a full-time team, real estate investing is work, and it takes a lot of time to get it right. You need to look at a lot of transactions before you find one. Oftentimes you have to bid on many things before you win a competitive bidding process. So it's time consuming. And then on top of that, you have costs associated with doing that. You have legal costs. You need to do some due diligence. You should always have an engineer look at a property. If you have anything complicated, you need to do an environmental assessment. So that those expenses can add up, and they can add up quickly. And I think people often underestimate what the cost of getting into the real estate game is upfront. And there are lots of stories about, again, get rich quick, where you don't have to do all the work and you can take shortcuts. And as we all know, yes, that sometimes works out, but shortcuts are rarely rewarded. So in order to get into real estate, if you're planning to buy the asset yourself, you need to set aside enough money and enough time to get started. That's why the allure of platforms like Republic and investing alongside other people who are doing this full time make a lot of sense for people that do want to generate just strictly passive income. They don't want to go to open houses. They don't want to negotiate. They don't have to hire a lawyer and be on the hook for the retainer and all those hourly fees. They want to invest in somebody who's done it before, know exactly what they're investing in. The deal is already done. They're investing in a transaction that's already been negotiated and closed, and they're along for the ride. And so I think that the point of this conversation is people know a lot about real estate investing, whether they think they do or not. Every single thing that you are in is real estate. When you walk down the street, that's real estate, and you have a gut instinct. How to invest in it becomes a little bit more complicated, but there are ways that you can break down that complexity. And the first one is by lowering the dollar amount that you're investing. If you invest $100,000, you should have a lot more hesitation than if you invest $1,000, right? Because $1,000, nobody wants to lose $1,000, but your life won't be ruined if you lose $1,000. So by investing in existing projects where you can invest small dollar amounts, you can build that confidence in a way that allows you to see lots of projects without losing lots of money on any one project, which is what would happen if you bought it yourself.
That's great. Great advice. When you think now about what you're most bullish on, we talked a little bit about cities, but I'm just curious from your perspective, what should people really be thinking about? What are you thinking about that you see as something that's the most exciting for you?
It's funny. I think coronavirus really kind of flipped the script on a lot of things just because I am definitely a bit of a contrarian. I think that humans are notoriously bad at timing markets. Humans don't like to run into burning buildings. We want to go where there's a party and not where there's a lot of fear. So in the cities like New York City and Portland and San Francisco, where you're hearing these headlines that are very scary, I think there are some really interesting opportunities to buy because humans also have really short memories. And a year from now, I strongly think we're going to look back on this period as a blip and we're all going to be having a wonderful time and we're going to go back to the cities that we love and eating in the restaurants that we love and going to the theater that we love. And that lifestyle is going to have the same allure that it did prior to the pandemic. And the people that had the foresight and the fortitude to invest in the pandemic while all those headlines were hitting are going to be rewarded. And a lot of the smart money, the really, really wealthy people who have not just a 10-year time horizon, but like a 25 or 50-year time horizon on their real estate investing, they are doing exactly that because they know that when, as Warren Buffett says, you want to be greedy when others are fearful and be fearful when others are greedy. And right now, a lot of people are fearful, which means that there are really good investment opportunities to be had for people that have the money and the know-how to pounce quickly. So I think those things are exciting. I don't like the idea of dancing on the grave of a city that's in trouble. But for me, it's less about that and more about doubling down on a lifestyle that I myself live and that I really believe in. I think the urban lifestyle is really exciting. And I think that, the world's population growth and job growth is still going to congregate in cities, not just in America, but overseas as well. And that trend is not going to, the decline that we're seeing or the perceived decline that people feel right now is a blip. And over the long term, we're going to look back and it's not going to mean anything.
So as a New Yorker myself, I've seen, especially during the pandemic, everyone fleeing the city. How do you think of that?
Everyone, that's the other thing. I think the news media is having a field day. I keep saying 15,000 apartments are vacant. Okay. Well, there are 5 million apartments in New York City. So, on a percentage basis, that's not that many. And yeah, it sounds really eye-popping, but there are 11 million people that live in New York City. So at any given time, there are at least 10,000 vacant apartments. That's just the normal course of events. And people are like, oh, there are U-Hauls parked outside of buildings everywhere. Guess what? 85% of leases roll in Manhattan in August and September. There are always U-Hauls parked outside of apartments in August and September. Are there more than usual? Yeah, I think there definitely are. I mean, I think you would have to be burying your head in the sand not to think that some people who are on the fence about city living took this as an opportunity to pull a ripcord. But is it this mass exodus? That was the word I saw used to describe what's happening in San Francisco. It is not. I mean, especially the wealthy people that I know that own apartments and homes in New York City and San Francisco, Washington, D.C., they're not selling. They may have gone to their second home, but they're not selling their places and they are coming back and they will come back. So I don't think that long-term any of these cities have anything to worry about. Near term is a different story. I think it's a mess. The lack of restaurants and things to do and schools being closed make it very difficult to live in cities right now. And so I think people are sensible in considering alternatives. But again, hammering home this point, real estate is about thinking in 7 to 10 year increments, not where we're going to be next May, but where we're going to be in May of 2030. And in 2030, unless there's another pandemic or something else weird happens, I feel strongly that New York City will be back to business as usual.
How would you define a good investor? What traits do you think he or she needs to have?
Patience, risk tolerance. I mean, investing does involve taking risk. It isn't gambling per se, but if you're a very, very conservative person who's prone to hiding your money under your mattress, that's not how you invest. And that's a different thing. That you have to be willing to take risk. You have to be willing to pay the price that the market asks. If you're one of those people that always think everything is overpriced, you're never going to get to the point where you invest, right? And there are certain people, they call them perma bears. They always think, oh, everything's overpriced. Prices are going to come down. Guess what? They're mostly wrong, because prices don't always come down. They often go up. And so you have to be the kind of person that is generally optimistic, and generally believes that prices are going to improve. There are people that make all of their money investing on the short side. They look for opportunity to take advantage of distress, and they believe the opposite. But I think most investors actually are fairly optimistic people by nature, and they believe that the future is a positive place, and they see the possibilities. And they're able to have some vision when they invest, because investing is about more than just spreadsheets. There's this whole other X factor. It's like this pixie dust. And when investments go really right, there's often a certain je ne sais quoi about a project or a place that a really shrewd investor is able to see that others may have missed.
That's great. Yeah, I think that's been a common theme with all the investors who are in the confident investor community, and that is, at the end of the day, we're really betting on the vision of the world that we see, that we want to see, that we want to bring to fruition, and that we truly believe in. And so that's the art and the science of investing.
Yeah, it's both. And I think it's true across lots of categories. Like, it's easy to invest in Uber when it's Uber, but it's harder to invest in Uber when it was an idea on a deck about, making taxis callable from your phone. And that sounds crazy, but the people that had the vision and could see how that could become a multi-billion-dollar opportunity were the people who became insanely wealthy through that company. And so I think it's a lot the same with real estate. The pioneers who have the vision and who are able to sniff out the next new thing are the ones that often make really big returns.
I'm curious what you would be if you weren't an investor.
I always wanted to have a cooking show on TV.
What would you be cooking?
I don't bake. It requires too much precision. I don't like measuring the flour and the sugar, but I love cooking. And I grew up watching Julia Child on PBS, and I always wanted to have a cooking show. So maybe in my next life.
Maybe it'll be in a nicely renovated kitchen.
Absolutely. The set is half the fun on a cooking show, right?
Awesome. So last question for you is just, what is the most important takeaway that you'd like to leave our audience with as they think about starting their own investing journey?
Think for the long term. There are so many bad cliches, and I think I've used many of them on this podcast, but I think some of them are really useful. It's like you want to skate to where the puck is headed, right? You don't necessarily want to invest for where the real estate market is today. You want to invest for where it's going to be in 7 to 10 years. So try to have a very long-term horizon and remind yourself that investing in real estate is like watching golf. It's a very slow game, and that's what you want. You expect slow, steady returns and not dramatic changes overnight. And so if you have that mindset, and it's very different from investing in the stock market or investing in the stock market today, where there's so much volatility and prices are rising and falling so quickly. It's a different style of investing. It's like if stock market investing is like boxing and running, then real estate investing is like yoga and meditation, And I think if you think about it at that pace and reset your expectations and reset the pace that you assume that the returns are going to occur at, you can be a very happy real estate investor.
Awesome. Any books that you would recommend for learning about real estate or just getting into real estate investing?
I don't know that I've ever read too many books about real estate investing. I read a lot of blogs and websites. The Real Deal is a great one from New York City. Cranes, the Wall Street Journal has a great Wednesday real estate section. The New York Post has a great real estate section. Curbed does a really good job. So I read all of those things to try to stay current on what's happening in the real estate world. Then if you want a novel that does a good job of explaining kind of the behind the scenes psyche of a developer, I would recommend A Man in Full by Tom Wolfe. It's a funny book. It's a good caricature of the developer persona, the testosterone-filled real estate developer, and I think it's very insightful.
Great. Well, thank you so much. This has been really helpful to me, and I'm sure for everyone who's listening in. So I'm excited to see. I'm excited to see where the cities go, and for all the work that you're doing as well at Republic.
Great. Thank you so much, Lisa.